To remain updated with the latest business news, click on the bell icon.
Our global business editor Udayan Mukherjee joining us now to decode what the markets hold in store for us in 2022. Udayan, a very happy new year and so much to look forward to after the fantastic returns everyone took home last year. What do you feel is in store, particularly in a year where we're beginning with questions around when the Fed will act, Omicron concerns and all kinds of volatility?
Hi Aabha, and wish you a very happy new year as well. I think, as you said, this is a year of multiple challenges for the market, particularly as it comes after 2 good years of gains. We have Omicron, we have the prospect of inflation rising in the US, and of course the withdrawal of easy money from the West has already begun, and you can see it already in the US dollar the way it has started moving. So putting it all together, the chances of it being a volatile year are quite high. And if investors look back into the history of how markets move, they will know that when you have a couple of good years on the trot, the odds of a market turning flat for a year or even giving you a mild negative return for a year are significantly high. And I think 2022, while it's not a given, runs the risk of being a flattish or even a mildly negative year for the stock market. But that should not deter investors. I think what investors should do is to say that we will not get thrown by the volatility, because it's easy to panic for investors who have not even seen a 15% correction over the last couple of years. I think they should not. The prudent course of action, unless something dramatic changes in the course of the year with inflation or earnings, I think the prudent course of action would be to stay the course, take this flat year or negative year in your stride, because if this earnings cycle is sanguine, over a 3-year period you will still end up making a lot of money. Stay put would be my advice.
All right, so stay invested. It is a long-term story. That's, of course, something that we always discuss. In terms of, and I know we're discussing equities here, Udayan, given that a lot of new investors have gotten tempted to, explore cryptocurrencies. People have been talking about gold emerging as the asset class of choice, particularly as inflation starts to spiral up as well. There's a lot of talk about real estate coming back, which has been completely dead and gone for the last 5-7 years. In light of some of this, do you feel equities will continue to be the asset class of choice?
The answer is not clear for 2022, Aabha. I mean, if you're asking what outperforms in the 12-month horizon, I think the answer is unclear. Equities may not be the best performing asset class in 2022. In fact, I would be surprised if it is the best performing asset class in 2022. But I am not a big fan of this kind of tactical asset allocation. It is better done in hindsight. Okay, this year gold did better and I had more in gold. Next year equities did better, so I had more in equities. None of us are so expert with that kind of asset allocation. And I think chances are that you will get it wrong. So my sense would be that even if there is a year where equities underperform, over a 5-year period or a 3-year period, which is the minimum that you should be investing for in any case, I would imagine that it's very hard to build a case where as fixed income or real estate or gold will outperform equities. Okay. 1-year time frame, absolutely it can. 3-year time frame with an earnings cycle which is tipping up like we are seeing it, I would be very, very surprised. I could be wrong, but I would be very surprised if that happens. So I would say for people who are looking at relative asset allocation, don't get sucked into that. Forget about 2022 returns and take 1 year of underperformance in your stride. Okay. I would still don't take money out of equity and put it into other asset classes if you have 3 years kind of a horizon. But for this year, you're right, Aabha, I think equities might underperform some other asset classes like gold or real estate.
Okay. And just in terms of investors who are, of course, continuing to track progress on equities, and we've been hearing a resounding view on how earnings are going to continue to look up. What is giving investors that kind of confidence in the earnings recovery? What are some of the factors at play here that lead to that positive outlook when it comes to growth here in India?
There are many factors, Aabha, but I think there is also the thing of mean reversion. We've not had an earnings cycle in India, proper earnings cycle, like we like to say 4-5 year earnings cycle, for the last decade. And it's only in the last year or a little bit more, maybe last 5 quarters, that we've seen some kind of an earnings cycle building up. Now everything reverts to mean in life, as we know, and I think mean reversion is part of what is working here, because Indian companies have taken the better part of the last decade to clean their balance sheets and to wait for their utilization ratios, how much of their plants are in operation, that to slowly start to tick up. So I think we are seeing some of that having been done already. The balance sheets are better, tax rates have come down, which leads to better earnings, and utilization ratios have slowly started to tick up. All of this you throw in, and plus the strong propulsion of mean reversion, which is a very important factor, I think we are probably at the cusp or in the first innings of an earnings revival. And that is the reason why the market is going up and nothing else, finally. If we falter on that front, and you've asked a very important question, if we find that during the course of the year, for some reason, earnings growth is not coming through after the first couple of quarters of this year, then I think we need to become very cautious about the market, because valuations are very expensive. But till we get a sense that earnings are beginning to disappoint again, I think we should go with the premise, or stay with the premise, that this is an earnings upcycle after many years, and therefore, despite the odd down year in the market, the prudent course of action would be to stay invested and to play this earnings cycle for its entirety. That's where most of the money tends to get made in any case.
If you like the video, do like, comment, share and subscribe.